Get the latest news at the click of a button inside your car. The new Bloomberg Business app. Now featuring Apple CarPlay and Android Auto. Listen to all your favorite Bloomberg radio stations and podcasts, including Bloomberg Surveillance, plus the latest news all on your dashboard. It's free and easy to use. Just download the Bloomberg Business app on your smartphone and connect the phone to your car. The Bloomberg Business app, now with Apple CarPlay and Android Auto features. Download it free in the Apple Store or on Google Play. Presented by our sponsor, Interactive Brokers. This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. Will we get back to 2% yield? That'll be a great story. I believe that's price up and yield down, if I get it right. Kathy Jones now gives perspective, Chief Fixed Income Strategist, in your kitchen this weekend of what to do. She's with Charles Schwab. I am absolutely fascinated with an always open question to you and Liz Ann Saunders. What are people at Schwab doing with their fixed income money?
Yeah, so what we see among sort of the majority of the clients is they've been staying very short in duration. They're starting to move out. They're starting to get some confidence that they can move a little bit further out the curve. They're staying in high quality. Treasuries, very, very popular along with CDs, not really dipping their toes into low quality, but at these yields, muni bonds, investment-grade corporates, treasuries are looking attractive, and they're getting a little bit more confident about stretching out duration.
The pros are worried about liquidity, whatever that means in the bond market. Should our viewers and listeners be worried about liquidity and full faith and credit, simple-to-buy duration bonds?
I don't think for the average investor, the liquidity issue is going to be a big one. I think for traders, I think for people like us navigating the markets for our clients, it's an issue. But I also don't think it's a critical issue right now in the market.
You are the one person who I was most looking forward to speaking to today. I really want to get your understanding of what happened with the failed auction yesterday and whether you give any credence whatsoever to this idea that the hack of ICBC, of the U.S. unit of ICBC, had something to do with how poor it went off.
I don't really know for sure. It is an open question because we haven't had something like this happen before. It seemed like the when-issued market was okay going into it. There were a lot of questions because we've had such a big rally at the long end, who would show up after rates dropped so much. So there's some questions about that. And then you start to get the Powell comments, and then you got the hack, whatever that may have had to do with it. So I think it's kind of a constellation of things. But we'd had such a big rally going into it after the 10-year went well and the 3-year went well. I think that had something to do with people stepping back.
What sort of signifies to you that we're actually getting stability in longer-term bond yields enough to get some conviction, to have some sort of trade that can last more than a couple days?
Yeah, we don't have it yet. Especially the further out the curve you go. You go beyond 10 years, you really don't have it. Even the 10-year, look at the volatility we've had recently, up 50 basis points, down 50 basis points. I don't think we're there yet. I think the market needs conviction that the Fed is really done and that the hold has some sort of time frame that you can anticipate. And then we start to get that stability. We thought we had it, and then Powell spoke, and we don't have it.
How much does this really have to do, though, with the Fed and its policy at a time when people are citing fiscal policy, or people are citing potential inflation, where people are citing just simply where are the buyers going to come from at a time of changing policy overseas?
Yeah, we haven't. So I tend to think it really has to do with three things that always influence the trend in rates. What the Fed is doing, because you have to discount that. There's no way you can get around the Fed, no matter how hard you try. What inflation is doing, which is tending to recede, and then how the economy is performing. And then you get into these other things like supply and who's buying, in China, Japan. But actually the foreign flows have been pretty steady, despite all this chatter. we've had the foreign flows hold pretty steady. The reserves are pretty steady. So I'm less worried about that. Fiscal policy, obviously it's a concern, but is it a concern today versus yesterday versus a week ago? That's a hard argument to make.
1 year out, am I clipping coupons, or can I actually invest for total return after a 3-year nightmare?
I think you can get some total return. It's not that hard when you've got a coupon this large to get a positive total return.
I'm going to clip the coupon and I'm going to get some capital gain out 12 months.
I think 12 months from now, yeah. We have fair value, say, in 10s, right around 4.25. And so if we get there, if we get even close to there, you're going to have a positive return.
Going into next week when we get CPI, how volatile is the market and how potentially massive could some of the moves be on the heels of either an upside or downside surprise?
Yeah, I don't think we're done with the volatility, Lisa. I think it's here to stay for a while until we get either that, confidence about where the Fed is and where it's going, which I don't think the Fed really wants to give us too much confidence, right? I think they want to keep the market a little bit off center, or we start to get those labor market numbers that are just so soft that the market says, oh, okay, now the Fed really has to start easing.
Kathy Jones of Charles Schwab. Ask Annmarie if the Balmain boom is over.
We'll ask her right now. Let's do this. We're going to conflate two stories together here this morning. We have a wonderful Bloomberg poll, some real acuity about where we are 12 months out from an election, and also, of course, Mr. Manchin's comments from West Virginia. Joining us now, Annmarie Hordern, Bloomberg luxury correspondent in Washington. Let's get that out of the way, Annmarie, right now. Is luxury so yesterday? Is it over in Washington?
I don't know if it was ever alive in Washington, but there is a sale at the moment, private sale, if you know who to know, at Balmain. So you can go check that out.
There we go.
It's not far from where you live.
Your weekend shopping with Annmarie Hordern. Annmarie, I want to conflate these two together. I've got Joe Manchin, who has lived 50% votes in West Virginia from the special election of Robert Byrd, 53% 8 years ago. Just to cut to the chase before the poll chat, did he make this decision because he really thought he couldn't win?
I think that's part of it. If you look at a recent Emerson poll and you have him against Republican Governor Jim Justice, he's trailing by about 13 points. This was going to be an incredibly challenging race for him. And he's already flirted with the fact that this was going to be the end of his time in the Senate. He's talked about the fact that he does think there needs to be a conversation about the middle, but also you have to look at the reality of what he's facing in West Virginia, and that was likely going to be a defeat.
Gregory Courtney and Marlo writing up our poll piece. It'll be talked about, I know, across all of your world today. Is there a middle in our Bloomberg poll, or does it show this mass polarity? Is the Joe Manchin middle out there in the Bloomberg poll?
Well, there absolutely is, because there's one key finding when it comes to RFK, and that's that he is taking from both. When you look at 2020 voters, he's definitely taking from Biden, but when you look at how voters feel right now, he is attracting Democrats because of his name cachet, right? He's a Kennedy, but he is also attracting Trump voters, and that has a lot to do with the fact that he is a lot of dialogue over the past 2 years when it comes to COVID-19 and this anti-vax movement. So he has 10%. He has obviously a ton of name ID and recognition, but there is this idea of what we're calling, quote, double haters. And that's about 19% we're seeing in our poll. And that's people who don't like the current president, Joe Biden, and definitely don't like the former president, Donald Trump.
Double haters. I love that. I think we're going to have to use that. There is this question as I look through some of the poll results about how President Biden could turn this around. We have a year left. Is there some material policy projection that you can hear about from the Democrats coalescing around the border, some sort of bipartisan agreement to try to deal with some of the problems that people are highlighting?
So I think there's two things that stand out here. One is that overwhelmingly in this poll of swing state voters, they want to see more being done at the southern border. It's 68% to 20% in terms of 20% disapprove of what's being done. When you look at the disapproval across things like Israel, Ukraine, that number is more. So what you're seeing here is that not a lot of people really want to see more work being done on the southern border. But Biden has put this all together in one big bill, and potentially because people are less concerned about, say, what's going on in Ukraine or China at the moment, that they are fine with having these separate bills, what we see Republicans are trying to do. I'd also note that this is a hard line for the president to walk right now, because still in our poll, like our poll showed last month, the economy rates number one. More than 40% of respondents say that is their top priority. When you look at the foreign policy concerns, 1% care about China, 3% care about what's going on in Israel. So immigration, the economy, abortion, those are ranking much higher in this poll.
And can I just ask a stupid question? Is it, when we talk about economy, are we just talking about inflation?
Well, that's what people are feeling, because the data shows that there's a lot of other optimism happening in the economy. This administration continues to use the superlative that for 21 months, the unemployment rate has been below 4%. That is a huge achievement, and that shows that we do have a very strong labor market. But time and time again, what people are concerned with is price of gasoline, price of groceries, their price of rental insurance that spiked over the summer. Mark Zandi in September came out and talked about the fact that before the pandemic, where prices are now, an average family that is making medium income is paying $734 more. And that's the problem with what the president is saying. The economy is doing better, and people are just not feeling it.
MH, how frustrated is this White House with these polls?
Very frustrated. The president was asked about it yesterday, and he says, you're just looking at CNN, you're just looking at New York Times. Well, this is our second Bloomberg News Morning Consult poll that focuses on the states that matter. These are the states that win elections. I think what the White House feels right now, or the campaign feels right now, is that Tuesday they had a great night. But Tuesday was all about abortion. And is that going to be top of mind of voters come November of next year? These are very interesting races. In Virginia, Glenn Youngkin made it about a 15-week limit. In Kentucky, it was kind of a unicorn governor race. And then in Ohio, it was specifically about abortion. And when you have Roe v. Wade being struck down by the Supreme Court, it means that the states are looking at abortion. So these are very state-specific issues.
You know, I look, Annmarie, I thought you're dead on the Zandi point. To me, the inflation's not the statistics we talk about on Bloomberg surveillance. It's the level from 2019. I think everyone out there, including me, is looking at every single item back to late 2019, very early 2020, and that's how you get to that $700 paycheck.
Couldn't agree more, Tom. That's the issue, TK.
I just, to me, it's
Without
the heart of the matter.
AMH, thank you. Annmarie, down in Washington, D.C.
Let's do this right now, and this is going to be fascinating. A first time in Las Vegas, and what you need to know is in the vicinity of Tuesday, it will be 73 degrees in Las Vegas. That doesn't matter if you run a race at 10 p.m. at night Pacific time, 1 a.m. Eastern time, 6 a.m. in the morning in Banbury, England, and the rest of it. Christian Horner is team principal and CEO of Oracle Red Bull Racing. And John, I'm sorry, it's about tires. That's what the experts tell us.
Christian, it could well be about tires. Good morning to you, sir, and thank you for being with us. I think we have to start by saying congratulations on an absolutely dominant season for you and the team. We'll spend some time talking about that in just a moment. Let's go where Tom went. Just approaching a new track you haven't had time with, you haven't raced on before, and with track temperatures that could be very, very low. Christian, what's the approach for you and the team going into an event like that one?
Take a jacket.
Is it that simple?
So, yeah, no, I was watching Max on the simulator yesterday driving around the circuit. It looks a great track. I mean, it's going to be super fast. There's going to be a lot of overtaking opportunities. And the tires, it could be like driving on ice. Which just adds another dimension. So particularly on a road course, on a street circuit, that can test the drivers and the team to the absolute maximum.
Christian, when it comes to stuff like qualifying then, how do you prepare to put that fast lap in that you try to do to get that quali in? How do you do that? What do you do? Set up with 3 laps before you go for the qualifying lap? What do you do?
Well, that's all going to come out of when we run on Friday for the first time. On Thursday for the first time, we're going to be learning, what it takes to get these Pirelli tires up to temperature, and is it going to be multiple laps in qualifying rather than a single lap? So it could be really interesting to see how that's how that's going to play out. There's going to be a lot of data to look at, and the simulators are going to be working flat out on certainly Thursday evening.
Christian, any worries that this could just be a bit of a disaster, could end up in chaos?
Well, look, street races are always dramatic. We've seen that in Singapore, we've seen it in Azerbaijan, and of course Monte Carlo. And this one promises to be a big one. I think it's going to be one of the biggest viewed events in the sporting calendar this year. And so, I'm confident it's going to be a great success.
Christian Horner, I was appalled by the accident very early in the Brazil race. Your Perez was very much involved in that. How do you make the start of the races safer?
I don't think you can. I mean, you've got cars that will accelerate from 0 to 100 miles an hour in less than 2 seconds. And you've got 20 very competitive drivers all going to try and make position into that first turn. So inevitably, sometimes there is going to be contact. But the safety of the cars, the safety of the circuits has increased dramatically. And, thankfully, we're seeing, drivers walking away from what sometimes look like very nasty accidents.
Christian, you said 20 competitive drivers. Arguably, there's 19, and then there's one guy on his own out in the front. I want to talk about that. The domination of Max Verstappen. He's still so young, Christian. He's taken over Alain Prost. He's basically on course to take over Vettel, maybe even in the next couple of races in terms of race wins. When you go back over the legends of this sport that you've been so close to over the years, Fangio, Senna, Schumacher, even more recently Hamilton, where does Max rank for you? What separates him from the rest?
Well, of course, it's always incredibly difficult to compare drivers from different generations. But what I think is safe to say with what Max has achieved in a short period of time, with now 3 World Championships, 51 or 52 Grand Prix victories, it's an incredible record. And I think that he can now be spoken about in the same sentence, in the same category as some of the greatest drivers that the sport has ever seen.
How far do you think he can go, Christian?
Well, I think he's still so young. He's still evolving as a driver, and particularly as he gains more experience. And a lot depends on the equipment that we can give him. But I think he can achieve a lot more. He's motivated. He's hungry, and he just loves his racing. You can see that he's not interested in anything else other than just going racing.
He's been dominant. Your whole team has been absolutely dominant. I remember Ferrari being accused of making the sport boring in the Schumacher years. Do you take it as a compliment when you hear those kind of accusations thrown at your team?
Well, it means that we're doing our job and that we're winning. But the one thing that's guaranteed in this sport is that nothing stands still. And I think with stable regulations, we can already see teams improving behind us. And I think that next year it's going to converge, and we're in for a much more tight championship next year, and also 25 before another reset with new regulations for 2026. So I'm expecting a much tougher year in 2024.
Right. Christian, to that point, and I have my Autosport at home. Jon Ferro made me get it. I try to read it and I try to understand it. A lot of your brethren are really trying to fix their cars now for next year. What do you do when you're as strong as you've been about tweaking the platform into the next season? Do you leave it alone? Do you leave the car the same as Verstappen is known this year? Or do you actually try to make improvements?
Well, you're always looking to improve, because you can guarantee our competitors are going to be improving. They will be copying some of the philosophy of our car. That's undoubted. We're already seeing that starting to happen. And we just got to keep trying to move the goalposts, to try and keep developing and improving ourselves. And so, of course, for the last few months, the factory have been very, very focused on that. But of course, you start to get into diminishing returns. And, it's going to be tough to improve the RB20 next year significantly from where RB19 has been this year.
Take us into the pit, because to some of us, I watch Netflix and I think I'm an expert. I'm not. Christian Horner, take us into the pit stop where you're 2.3 seconds, 2.8 seconds. How do you train for that excellence versus the other teams?
Well, it's the same as in any discipline. It's all about practice. It's about analysis. It's about the small incremental things, just where the driver stops. If he's 2 inches too long, then that will affect the timing of the stop. So it's rehearsal, it's practice, it's positioning the right people in the right roles. is having the right attitude and the determination to continually improve and, of course, be consistent.
Christian, let's talk about next year. You've got 2 drivers, both under contract. There is a question mark over one of them, Checo. The drivers you have in the cars in the coming weekends, are they going to be the same 2 next year?
The only people that keep putting the question mark are you guys. I mean, we keep repeating that Checo's going to be our driver, next year, and he's had a tough 6 weeks, but he started to refine his form. I thought the race that he drove in Sao Paulo was very strong. His race in Austin was strong, and he's finding his form again. He's second in the World Championship. He's over 30 points ahead of Lewis Hamilton with 2 races to go. So, let's see what he can do over these next couple of races, but he will be our driver alongside Max in 2024.
As a team, are you expecting Max to help him secure that second position, or does he have to do this on his own?
No, I don't think he'll need the help from Max, to be honest with you. I think he just needs to finish either ahead or just behind Lewis this weekend to secure that second position. I think we're treating these remaining races as cup finals, and that's how we've operated since winning the championship a few races ago in Qatar, and each race holds huge importance to us. And to race in Vegas, it's going to be a phenomenal thing, and we're going to be chasing our 20th victory of the year there for sure. And it's just very nice of them to have put a race on to celebrate my 50th birthday, I think, particularly in Las Vegas.
Christian, you asked for it. Happy birthday. It's fantastic to catch up with you, sir. Congratulations on an absolutely dominant season. It's just been phenomenal to see play out all year. And thank you also, Christian, to you and the team for being a fantastic partner with this program over the last few months as well. Christian Horner there, Team Principal and CEO of Oracle Red Bull Racing. Troy Gayeski joins us now, Chief Market Strategist at FS Investments. Troy, wonderful to have you with us on the program. Let's start with fixed income. Did we confuse a bond market rally for bond market stability?
Yeah, so, first of all, humility is in order for any forecaster right now. But so much of this cycle, whether it's rates or equities, is there's market price action, and then there's narratives that follow that price action. And, if you think of the way yields have gone higher this cycle, we've got to 3.25 for a picosecond, rallied back. Then we got to 4.25 for a nanosecond. And Tom, you really like this one. We got to 5 for a femtosecond and then rallied back hard because the positioning was so bearish. And so we came back down hard, and then the narrative builds that, we've reached the peak in yields. And then, of course, you either have a bad auction or you have Powell pushing back and, you have a 20 basis point gap higher.
The geek from MIT is 10 to the -9 this morning. Troy Gayeski, let's go to the reality. Get out the calendar. Everybody's got to catch up. I'm going to give credit to Goldman Sachs, a chart on how hedge funds were out of the market before our 8-day rally. You talk about the edge. You own the word alpha. How do we create alpha? Not the year end. How do I create alpha out to the summer of 24?
Well, so I think in a time like this, most of your positioning should be in what we refer to as Northwest Quadrant strategies of the efficient frontier, where you have lower vol, you're maturely accepting consistent returns. So, there's a few areas we've been focused on heavily. One would be prepayment sensitive RMBS, because given where yields are today, there's going to be incredibly low refi activity, really as far as the eye can see. So that's one area you're getting attractive carry. Spreads are relatively wide. We're not counting on spreads to tighten anytime soon until at least the Fed stops QT, which won't happen until recession. But if there is a harder landing and they do QE, then obviously spreads are going to come in significantly. So you get income plus price appreciation. Another area, Tom, non-speculative on the direction of rates has been yield curve steepeners. Whether we get a bull steepener like we had earlier this year or a bear steepener more recently, we're fairly agnostic. And then for those that can tolerate less liquidity, when you think of this environment as a private lender, you have the bank stepping back, you have higher for longer, and these are all floating rate loans. So in what we refer to as a dare to dream scenario, where we keep rates high and we can avoid recession, you're going to have very attractive income, and you're not going to have the hangover of a recession. So those are 3 areas, Tom.
To translate the jargon frenzy you just heard, Gayeski's trying to capture the coupon right now. Troy, tell me about the equity markets and technology stocks. They have been on fire recently. Does the fire continue?
Well, when you look at an asset allocation, there's certainly no reason not to own growth, right? I mean, I never understand these arguments why you shouldn't own growth. You should own international. You should own Japan. You should own EM. I mean, this is a winner-take-all economy, both in the U.S. and globally. And unfortunately, or fortunately, depending upon how you look at it, that's really concentrated in the top 5-10 names in the S&P. So the issue we've had with big cap tech, particularly over the last several weeks, or mega cap tech, is are the valuations reasonable given realistic earnings going forward? Obviously, earnings are not going to be nearly as strong as they were the past 5-7 years. And we look at those multiples in the event of another round of multiple compression driven by Fed QT and money supply contraction, you're more than likely going to have some price declines. But as far as a secular holding, we don't know why you wouldn't have some in your portfolio. And then you look for other things to complement that in a very volatile market environment.
Can you give us a window, Troy, into the debates that you have at FS Investments about your year-ahead outlook for 2024?
Oh, yeah. So the debates are obviously a lot of fun. But, when you think of the economy, we've always been in the higher for longer camp. That being said, even we're surprised at how resilient the economy's been. What we're trying to fine tune, and we don't claim to have a crystal ball, of course, is what's the probability of recession in the next 12 to 18 months? Is it 50%, 60%? It's arguably higher than 40, probably no higher than 60. And what's the environment where the Fed can thread the needle? What's the probability of that, whether it's 40% or 30 or even 50? Because of the increased business fixed investment and construction spending, because state and local governments can spend, because the housing market at least isn't a dramatic drag on GDP. And then in turn, what does that mean for inflation forecasts? So, from a macro standpoint, it's trying with, again, humility to understand in which scenarios do certain trade expressions generate attractive returns, and in which other scenarios do you get better upside or better convexity, a phrase that I know Tom loves well.
Troy, given the range of potential outcomes, are longer-term treasuries virtually uninvestable unless yields are so high to compensate for all of those scenarios?
Well, so that gets back to the scenario analysis. We have cautioned everyone in fixed income that, again, every time market yields have popped up, just be aware before it's said and done, before we have that next recession, you could really get hammered with a bear steepener. And that's obviously what happened up until recently. You clearly have better risk reward in fixed income today than a year ago or 2 years ago. But until we have that recessionary outcome, or until at least markets truly price it in, not fictitiously price it in, but truly price it in, all you're going to earn is your yield, and you're going to have tremendous amounts of volatility. So we don't think it's time yet to extend duration cavalierly, but you more than likely want to think about that and understand that in a recessionary scenario, you don't have as much upside as you've had historically, because, where's the 10-year going to go? Front end goes to 3, 10-year goes to 3.25, 3.5. So you have upside, but not like the GFC or the Eurozone crisis or the pandemic or 2002. But if we stay in this dare to dream scenario and the Fed can thread the needle, you're going to get no price upside. You're going to have still a relatively low yield compared to when we had inflation this high in the past. And you could get some adverse market price action again, like we did yesterday.
A repeat of yesterday is not what many people want right now. Troy, thank you, sir. It's good to catch up, buddy, as always. Troy Gayeski of FS Investments, following a steep day of losses on the S&P 500.
I have not spoken about Byron Wien. What a joy it was for me sliding in here at Bloomberg, and the privilege, Steve Roach at Morgan Stanley, Barton Biggs. I have the clearest memories of talking to Barton. He died tragically too young. And Byron Wien with a full life, dying recently. Byron Wien with the wisdom and what he did and his annual guesstimates of the future. And Doug Kass joining now, who knew Byron better than me. And I think what Doug Kass, to me, the ultimate thing I could say about Byron Wien, he was so good that when he got something wrong, you studied why he got it wrong. It was just that good.
It's like what Yogi Berra said about my cousin Sandy when he went 25-5. I know why he won 25 games, but I don't know how he lost 5.
It's like that. I mean, Byron came out with X number of calls, and he was right, and everybody was that. But the humility wrapped around it.
I met him back in 1980. We formed something called the First Tuesday of the Month Club with Julian Robertson, with Lee Kuperman, who was at Goldman Sachs at the time, Susan Byrne, who was at J.P. Morgan and had not yet formed Westwood Management, Lou Margolis, who ran Solomon's institutional business, David Rocker from Rocker Partners, and, of course, someone who Barton Biggs called in his hedgehogging book the bearded prophet of the apocalypse, Tony Salufo, who was the head trader of Michael Steinhardt. And we dueled. We quickly became friends. He became an important mentor to me. We dueled in our annual surprise lists since 2002. I so anxiously awaited his constructive criticism and his responses to my list on thestreet.com. I still write it. But the most important thing to me is someone with a short-selling bias, concerning the multiple economic tragedies and the market swoons over the last several decades. It was also easy to get bearish at the bottoms when things were obvious. But Byron taught me something in an immortal phrase. He said, "Disasters have a way of not happening." And that dictum emboldened me in March of 2009, in May of 2020, and in October of 2022 to buy stocks. And the second favorite quote I have from Byron is something that he wrote about in the Jewish Journal when he hit 80 years of age. He said, quote, "I still ski, I play tennis, I sail and make love, although my skills at all of these have slightly deteriorated."
Well, that's a perfect segue into Lisa Abramowicz.
Oh, my goodness.
First time, long time.
Tom, really? I will say, Doug, trying to shift gears a little bit when you're talking about catastrophes don't happen. How then do you get bearish at a time where the catastrophe is what hasn't happened and everyone has been surprised by that?
Well, as we discussed in my last Bloomberg interview about 2 or 3 weeks ago, we've had 14 years of absurdly loose monetary policy when coupled with aggressive fiscal largesse, in large measure a reaction to the COVID epidemic. It's distorted our economy, Bramo, and our markets. It's resulted in an economy that, for up till now, has been immunized and has contributed to a much longer lag for the tightening in monetary policy to take hold than in any other cycle in history. But this is going to change, and the best distortion is in the housing market. The existing home turnover is frozen for obvious reasons. That said, affordability has been so extended that the price will shortly be paid. Alan Abelson at Barron's used to say, as night follows day, and as the night follows day, the lagged impact and the economic downturn is going to soon be upon us.
I'm surrounded by gloom here. I got Bramo and Kass digging a hole. But the fact is, and this goes to Byron Wien and Barton Biggs, Doug Kass, we came out of 74 with that shock bull market. Then we paused, and then I'm going to guess in 77 somewhere, we got a second leg of a bull market. Is this a second leg off the October low that we saw in 22?
I don't think so. I think the question is not whether one should be short, whether I should be short, but how short I should be. I think the mistake that many are making, and you've discussed this in the last 48 hours, is that everyone's looking at the slight improvement in the rate of inflation over the last couple of months, thanks in large measure, obviously, to the lower price of oil. But the real concern to me, and the real reason there's growing evidence that the consumer is starting to roll over badly, is that stacked inflation, the cumulative rise over the last 3 years, is debilitating. And you're seeing that in all sorts of industries. You see Diageo's shares is down. It's the largest liquor distributor in the world. It's down 15%. There's weakness. The bug extermination companies are suffering because it's a discretionary expenditure that is being pulled down. As we mentioned before, pet companies are suffering because the discretionary items like play toys and Chewies are reduced. But the real big story in this market is that it hasn't been a bull market. It's been a market that is so bifurcated. Never in history has it been so bifurcated. And I look back into stuff that Bob Farrell used to say in his lessons to investing, and he used to say that markets are the strongest when they're broad and weakest when they're narrow to a handful of blue chip names, and that's exactly what's occurring.
But it's been occurring for a long time, Doug. And just
the market has made no progress.
But there's
November 21, there's been a lot of action. There's a lot of opportunistic trading opportunities. Remember, Bramo, let's look at the 2021 top, which was an important top, and we're not far off from it. The yield today on the 1 year is 5.4% on Treasuries. It was 30 basis points then.
So
as important 2 years ago, the economy was progressing well. Today, we're on the cusp of a recession, and that helps to explain that we have a paper-thin equity risk premium, which portends lower returns.
There's a question around how to be short. If you are short, can you go short a whole index, or are you taking a look at the losses and say small caps and leaning into that and saying that if we're going to get a recession, that's the surest bet?
Sure. I think the best bet today is an odd pairs bet, which few are talking about. If you look at the ratio of equal weighted S&P relative to the capitalization weighted S&P, it's fallen to the lowest level since September 2020. If you look at the chart that indicates that the NASDAQ has outperformed the Russell Index, it's the largest margin in 27 years. And finally, technology stocks have hit an all-time high relative to the S&P index. So my pair trade, and by the way, also short interest in the Magnificent Seven is at an all-time low. So my pair trade is long the Russell Index and short Qs, short the NASDAQ.
Doug, quick question here. My trade is long Koufax and long Ohtani. Is Ohtani the new Sandy Koufax?
Boy, I just saw he gave out 60,000 gloves to kids in elementary school in Japan. He's a great guy.
Which team is he going to play for? Cut to the chase. You know everybody down there. He's in Florida. Doug's like dining with all the owners. Who's going to land Ohtani?
No, he'll end up with the Yankees.
There we go. Doug Kass, thank you so much. From Seabreeze, there for our New York City audience. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.